Great to see you today, Jim. So let me get this straight. You're looking at ETFs and funds from around the world at a time when we're seeing the biggest war in Europe since World War II. You're seeing China really struggling. That makes up a lot of international funds. So what are you looking at that makes you think, this might be a great area of investment?
Well, one thing, Contessa, is I am kind of amazed how well international stocks across a wide variety of styles and countries are doing relative to the U.S. market in a time when, as you say, we have so much turbulence. Like you said, a war sitting right in Europe, the worst since World War II, setting off one of the worst energy crises we've had, and a lot of the international market is subjected to that more than most. With, as you say, China, the leader of the emerging world, struggling. You've got a dollar, which is up 15% in the last year. Always bad for international stock returns when you repatriate them. And then we've got recession fears that are rampant. As you say, why would you leave the shores of the safety of the U.S. to go abroad? And yet that's what I see. I'm looking at frontier markets and emerging markets, even with China, that are market performers relative to the SPY this year. If I exclude China, the EM ex-China, it's outperforming the S&P 500. If I look at international small stocks, they're outperforming. You see international value stocks are killing it. If I go to individual countries, a place like the UK is having a banner year. Aussie and Canada, as we might suspect, energy-related, doing really well. But what's really surprising is places like Japan and even the Eurozone itself are just slight underperformers year to date. So one of the things that gives me some optimism is that if they're doing this well in a bad environment, Contessa, then maybe that sets up a possibility that they're finally turning the corner here. If they can hold up this well in bad times, how well will they do if things turn out a little bit better? And I think it's a good time to enter these stocks finally. As you said, they're almost under-owned in every portfolio, and their relative values are very, very attractive. And maybe, just maybe, they're finally turning the corner.
I know you're also doing a look back, Jim, some research looking at the consumer price index and where inflation peaks and its correlation to recession and what happens with the stock market after that. And you've come to, I think, a pretty optimistic conclusion.
Yeah, I have. I look back, Contessa, to 1940. And I highlighted 17 different peaks in the inflation rate over that period of time. And what you do find out is that 8 out of the 17 times of those peaks, we have recessions. So it does elevate recession risk almost to half the time. But 6 out of those 8 periods, a recession was already in place prior to the peak of inflation. So by the time inflation peaked, inflation was more over than coming. Of the 9 that didn't recess over that period of time, the average length to the next recession during those periods was still almost 3.5 years overall. Second point I make is that every one of the 17 inflation peaks was a spike top. There was no rounded tops. Inflation goes down about as fast as it comes up in every instance. Of the 5 inflations that we had that were 8% or more, like the one we've had today, 2 in the 40s, 1 in the 50s, and 2 in the 80s, all of those on average fell by 1/2 the inflation rate within 1 year. So if that happens here, we'll be down to 4% a year from now overall.
All right.
The big thing is what it does to stocks. Of all 17 inflation peaks, the stock market in the coming year from the peak was up on average by 13.2%. If we didn't have recession, it was up by 17.2%. And even if we had a recession, it was up by almost 9%. So I just think inflation peaks historically are great entry points for the stock market.